Hey everyone, welcome. So the UAE's new corporate tax, it's been the talk of the town, right? And look, I get it. It can seem a little complicated on the surface, but my goal here is to just cut through all that noise. I want to show you how this system is actually built to be pretty straightforward, super competitive, and honestly, really friendly to businesses. So, ready to jump in? Let's do it.
All right, here's what we've got on tap. We're going to start with the tax rates, which are pretty attractive. Then we'll get into the nitty-gritty of who actually pays this tax and on what income. After that, we'll tackle the big one, free zones. Then we'll cover how to stay out of trouble with smart compliance, and we'll wrap it all up with a simple action plan so you know exactly what your next steps should be.
So first up, let's talk numbers. The main message from the UAE is loud and clear. They are absolutely committed to staying a super competitive, low-tax place for businesses to really succeed.
Okay, let's kick things off with a number you're going to love. 0. That's right, 0%. This isn't a typo. Your first 375,000 dirhams of profit are taxed at 0%. That is a huge benefit. And it's no accident, you know? It's a really smart move designed to give startups and small businesses that crucial breathing room they need to grow and reinvest right back into their companies.
And what about profits that go above that amount? Well, the standard rate is just 9%. So think about it. You only start paying this really competitive rate after your business is already making some serious profit. This whole setup just cements the UAE spot as one of the best places in the world to do business.
Okay, so those rates sound great, but who do they actually apply to? This brings us to a couple of really fundamental questions. What exactly is a taxable person, and how do you figure out your taxable profit? Getting these definitions down is absolutely key.
The law is really specific on this. First, you've got what are called juridical persons, which is just a fancy way of saying any company in the UAE. Doesn't matter if it's on the mainland or in a free zone. Then there are natural persons, which means individuals. And here's the important part for individuals. You only fall into this category if your business turnover goes over 1 million dirhams in a year. We're not talking about your personal salary or rental income or any investment gains. All of that is not part of this tax.
Next up, let's talk taxable profit. This is where people can get a little tripped up. You can't just look at the profit on your financial statements and call it a day. You start there with your accounting profit, sure, but then you have to make a few specific adjustments that the law requires to get to your final taxable profit number.
The whole calculation is actually a pretty logical three-step process. You start with your profit from your books, then you find any expenses that aren't fully deductible for tax purposes and add them back in. And boom, what you're left with is your taxable profit. That's the number the 0% or 9% rate gets applied to. Simple as that.
So what kind of expenses are we talking about here? Well, here are a few classic examples. Your everyday operating costs, like paying your employees or your office rent, those are fully deductible. But then you have something like client entertainment. You can only deduct half of that. And things like government fines or penalties, nope, those are completely non-deductible. You've got to add the whole amount back to your profit.
All right, let's switch gears and talk about something that's super important for a lot of you out there. Free zones. I mean, many companies are in free zones for the tax perks, right? The new law keeps that 0% rate as an option, but, and this is a big but, there are some very specific hoops you have to jump through.
So if you want to get that 0% rate on what's called your qualifying income, you have to tick all 5 of these boxes every single year. It means you need a real office and real people working there. You have to earn the right type of income, keep your other income super low, price any deals with your own other companies fairly, and get your books audited. It's not a given, you definitely have to earn it.
Let's zoom in on that de minimis test for a second. It's all about keeping things in balance. Basically, your non-qualifying income can't be more than 5% of your total revenue, or 5 million dirhams, whichever number is lower. And trust me, you don't want to mess this up. If you go over that limit, you could lose your 0% status for 5 whole years.
Now, I really need you to listen to this next part because it is so important. Even if you're a free zone company and you're pretty sure you're going to pay 0 tax, you still have to register for corporate tax and you still have to file a return. No exceptions. Just assuming you're exempt is probably one of the biggest and most expensive mistakes you could possibly make.
So knowing the rules is step 1. Step 2 is making sure you actually follow them. Smart compliance is really what's going to protect your business from those common mistakes that can end up costing you a lot of money in penalties.
A huge concept you need to understand is the arm's length principle. This is all about transactions between related companies, say a parent company and its subsidiary. The rule is simple. You have to price that transaction as if you were dealing with a total stranger.
It's all about preventing companies from just shifting profits around to get a better tax deal. It has to be fair market value.
And if you don't follow the rules, well, the penalties are no joke. Register late? That's a 10,000 dirham penalty. Don't keep good enough records? That's another 10,000 dirhams, just for the first time. These aren't just slaps on the wrist. They're serious fines designed to make sure everyone takes this seriously right from the start.
And that brings us to our last section, your action plan. We've gone over the rates, the rules, the risks. Now let's translate all that knowledge into some clear, concrete steps for your business.
First things first, registration. Your deadline is tied to your business license. Just find the month your license was first issued, and that will tell you your deadline. So for example, if you got your license in May of any year, your deadline is July 31st, 2024. Whatever you do, do not miss this date.
Okay, once you're registered, the next big step is filing your tax return. You've got 9 months after your financial year ends to get it done, and you'll do it all online through the Amara Tax Portal. And just a reminder, if you're a qualifying free zone company, or if your revenue is over 50 million dirhams, you absolutely must have audited financial statements to submit with your return. You know, when you boil it all down, it really comes back to this one idea. Being proactive is your best defense. Don't wait until the last minute. Getting ahead of this stuff is the smartest way to make this whole process smooth and stress-free.
So I'll leave you with this question. We've walked through the whole framework. The rates, the rules, the deadlines, it's all there. The real question now is, are you ready? What are you going to do today to make sure your business is prepared for its first corporate tax filing? Thanks so much for joining me.